Don Luskin, Mr. Bernanke also hinted at two other points I want to raise with you. Number one, he seems to be suggesting a Goldilocks soft landing. Their Fed forecast this year is 2.5% or thereabouts. And number two, Don, as I read it, this is my interpretation, he's saying, yes, there is a low-grade credit virus infection in the markets, but it's no big deal, and it seems to me he's suggesting it's going to go away soon. You agree with him on those points?
Right. Now, this infection, let's be clear, is really just a renormalization. It's just interest rates going, credit rates going from extremely crazy low, print the money and give it away levels to rational levels. For instance, junk bond spreads have merely returned to normal. They are not excessive like they were, say, in 2002. The problem is, when you've been dirt cheap for a couple of years, merely normal is quite a surprise to people who were counting on doing their financing at subnormal rates. So there's been a lockup in the bond market. There's a lot of gnashing of teeth, a lot of very highly paid people getting fired because they made trading mistakes, and that's going to cause a problem. But Bernanke is wisely realizing that markets do this. Mama said there'd be days like this. There'd be days like this, Mama said, and we will get through it, and Bernanke's right to say that.
You're coming around to Bernanke. I hear some Bernanke sympathies from you that I've not
Larry,
heard
I've got to tell you, you just remember, in judging Bernanke, you have to remember what the Fed is all about. The Fed's mandate is, number one, stable prices. Number two, full employment. And number three, disappointing Jim Cramer. He did all three today.
All right. You'll pardon me if I don't comment on number three. I do want to put a chart up on the full screen, and that is the 5-year forward Treasury tips inflation spread. Something which rumor has it that Mr. Bernanke looks at very closely. If we can get that up on the full screen. Now, that spread is actually rising this year to date. You can see it on the board. In fact, the bottoms are higher, and we're up close to 250 basis points. That spread is ignoring credit deflation. It is ignoring the credit virus. It is ignoring worries of bears that the economy is going to heck in a handbag. Wayne Angel, what do you make of that inflation spread? Why do you think it's so stubbornly high? It's been rising. And by the way, as you know, Mr. Bernanke likes to look at those spreads. They're market-driven. It's his version of a price rule.
Well, he's following an item that I wouldn't follow at all. What I would do is I would take a page out of Milton Friedman's book and say that inflation is strictly a monetary phenomena. When the Fed chooses to say that 2% growth, 1.5% growth, 1.7 average for the first half of this year, well, when he says that that's normal, well, then when you slow the economy down that much, you don't produce as many goods and services, and consequently the inflation rate is likely to tick up, but this time it's not doing it.
Well, Don Luskin, what do you make of this rising inflation spread? It is very interesting, and I dare say, I know you're worried about inflation. I know you follow gold. Heck, everybody on this panel follows gold. What do you make of this? Do you think that, therefore, this confirms Bernanke's view that he should be an inflation gunslinger?
I think it does. I don't have a lot of faith in the tip spread. There are a lot of technical reasons that some very smart economists on the Fed staff have written about that really throw into question whether it's all that valid a mechanism, has that much predictability. But, you know, it's part of a unanimous vote. You know, look at gold, look at commodities, look at oil, look at the dollar. It's all saying inflation. It's all the classic science. You don't need a tips market to tell you that. It's just all unanimous. It's inflation, babe.
All right, Bob McTeer, final thought to you. I'm still waiting for some Federal Reserve member, either a big shot or a middle shot, to say somewhere. Maybe they're going to whisper it in the middle of Washington, D.C., or in a restaurant here in New York. But they're going to say to somebody, so it's picked up by the press, that the Fed remains as the lender of last resort in the event of a financial emergency. And yes, the discount window is still open, just in case. I'm waiting for that shoe to fall, Bob McTeer. Will it fall, in your judgment?
Well, I think you just dropped it. People are watching, and they know that's true. The problem is, under conditions like this, banks are very reluctant to go to the Fed's discount window because they'll be afraid the markets will take it as a sign of trouble.
What do you mean? That would be, but you mean, but does word get out? I'm not aware of that. If Citibank or somebody, J.P. Morgan, went in, you guys won't release the name of the borrower, will you? You guys, your former guys, you won't release the name of the borrower, will you?
I believe that's public information. Perhaps not immediately, but it's easily discerned.
Oh, I didn't know that. Wayne Angel, is that true? You're a longtime governor of the Federal Reserve Board. You released that stuff? Did you when you were there?
Yes, it's not a good idea to have subprime lending be under the hit that it's now under. And we're going to see credit allocation is going to be curtailed. And as credit grows more slowly, then the economy is going to continue to move along at a 1.7% average growth rate, and that's too slow.
So you think that the Fed's forecast is too high in terms of growth. What you're saying is this credit virus, however defined, is going to bring the economy slower. And that is going to be one factor bringing the Fed to ease. Is that your scenario? What
I'm saying is the Fed doesn't even take correction when its own forecast is proven to be an error. They forecast 6 months ago that the housing event would be over, and it's not over. And they were forecasting there were pressure on prices, but we don't see any pressure on prices. So I think they need to look at their own forecast mistakes.
All right, very well. Gentlemen, thank you. Bob McTeer, Wayne Angel, Don Luskin, you got to hang with us, buddy. We got a lot more work for you coming up.